Welcome back, ladies and gentlemen. It's Benedict back here again, and in our previous video we talked about parties to or other parties interested in financial statement. We also talked about accounting concepts, rules and conventions, of which we talked about various concepts and conventions. We also talked about debit, credit, and did not finish on the part of accounting equations. I want us to move on with the accounting equation, and then we'll mention we'll try to revisit the portion of debit and credit, and then we'll see the accounting equation, and then we'll finalize with the users of accounting information. So let me just take you to the other template where we'll explain what is meant by debit, credit, and the accounting equation, and the users to accounting information. So here we are talking about accounting concepts and accounting conventions, and we had said that debit is an accounting entry that either increases an asset or expense account, or decreases a liability or equity account. It is positioned to the left, the left hand in an accounting entry. And then we also say that a debit note is a debit memo, and it is a document issued by a seller to a buyer, notify them of the current debt obligations. And then we also said that a debit note is also given when a customer returns goods to a business received on credit. In this case, the buyer issues a debit note to the seller. Okay. So a debit note to the seller is the opposite of a credit note to the buyer. Rather, credit note to the buyer, yes. We've just mentioned that a debit note is also given when a customer returns goods to a business received on credit. In this case, the buyer issues a debit note to the seller. So when the buyer issues a credit note, it means that he or she is reducing the value that is supposed to pay the seller. So on the account of the buyer, where he has received goods on credit, he has a liability to pay seller. So on that debit note, for it to effect it, you will debit the account having the liability to reduce the amount, the value of the goods received. Okay, and will also credit the goods, rather the stock item or the goods, to reduce the amount of stock that is available account. So we will be having two entries. We will debit the liability side, and we'll also credit the stock side for the goods that he's supposed to pay. So again, we've also said credit note is an accounting entry that either increases a liability. Rather, we've said a credit is an accounting entry that either increases a liability or equity account, or decreases an asset or an expense account. It is positioned to the right in the right hand side of an accounting entry. For example, if you have an asset account, or rather you want to purchase an asset and you have some amount in your bank, the bank account maintains the asset account in terms of cash. So when you buy an asset, you'll debit the asset account because you bought an asset, but you'll also credit the bank account because you've used money to buy an asset. So the bank account has been reduced by the value of the asset that you bought. So you must credit bank side and debit the asset account. And then we are also saying it increases a liability. So when you buy values, you buy goods on credit, it means you'll pay after. You have the liability of paying these goods at a later date. So you'll credit liability, meaning you'll increase the liability account also because you've received the goods that you are buying on credit. You'll also debit the stock account. You'll debit the goods. Again, when you have an expense account, let's say maybe your employees have worked for you for the month of January, and now you need to recognize the expense of their salaries. So it then means that you'll debit the expense account for salaries, you'll credit liability for accrued salaries. The salaries will have been accrued because you are supposed to pay, but you've not paid, so you accrue them. So it is a liability. You'll credit the liability side of the accrued salaries, and when you come to expense account for salaries, you'll debit the expense account. Okay. And again, when you realize that the expense that you've captured for salaries is not correct, you want to reduce it. Maybe it was $6,000 or $2,000, but it's supposed to be $1,000. So you'll come to expense account because expenses are always debits. They are always in debit, and you want to reduce it. So you'll come and credit the expense account, and then you'll go and debit the liability account of the amount that you accrued as an expense. Then we have a credit note. So we are saying a credit note is a document issued by a seller to a buyer to notify that the credit is being applied to their account. So you sold good to a customer, and then you realize that the goods that you sold were not of that value. Maybe you told the customer, or you had invoiced them as worth 1,000, maybe $1,500. But now you've realized that the goods that you had invoiced worth $1,500 are only worth $1,000. So you need to give a credit note of $500 to the customer. So when you issue a credit note, the account of the customer of whom you issued these goods on credit and now is amount receivable, you need to reduce that amount receivable by $500. So you will credit that account because receivables are always in debit. They are always debit balances. They are always assets. So you need to reduce the asset value by 500 with the credit note. So you will credit the account of the customer, and then you'll debit the value of the goods that you sold the customer, because what you gave the customer is not the true value of the amount that we invoiced. So now you want to reduce the value that you gave to the customer. So you'll credit the customer's account or receivables account and debit the goods account or stock account. So that was a recap on debit note, credit, and credit note. And then we also talked of credit note being issued for various reasons. Okay, we had not talked about the reasons, but now we are talking about the reasons why a credit note has to be issued. A credit note will be issued in the following reasons. The reasons here are these four reasons. There could be more, but these are the major four reasons why a credit note will be issued. We issued a credit note when changes to an order after invoice is issued, when goods returned or services rejected, when goods were damaged during shipping, or pricing mistakes on the original invoice. So this is when you issue a credit note to the customer. And then we are also saying no money is exchanged in a credit note. It is used to offset the previous invoice. It is used to offset the previous value of the invoice that you had taken to the customer. So now let's continue with the accounting equation. And now we are saying accounting equation. Accounting equation is said to mean the balance sheet equation, and it states that a business total assets are equal to the sum of its liabilities and its shareholders equity. And we had said liabilities are what the business owes, what business is supposed to pay to suppliers or creditors or maybe investors. Those ones are liabilities. And then shareholders equity, we say shareholders equity is the value of the capital injected in the business and the retained earnings. So the retained earnings could be negative or positive. When it is negative, we say the value of expenses is more than the value of revenue received from customers. So we get a net loss. So net loss, when we carry over to the next period, we call them retained losses. So retained losses plus capital injected in the business is also called shareholders equity. Or when the values of revenues inflowing to the business is more than the value of expenses being paid out from the business, we talk of net income. So net income, when carried to the next period, call it retained earnings, and then retained earnings plus shareholders capital or amount that has been injected into the business into capital. You say that one it is shareholders equity. So shareholders equity is capital plus retained earnings. And then we are saying it is the foundation of double entry concept in accounting. Remember what we said about double entry concept. We were saying for every debit entry, there must be credit entry. And for every credit entry, there must be debit entry. Okay? For every amount you received, that amount must have come from a place. For every amount given out, that amount being given out, it must have affected a particular account. Somebody is receiving and somebody is giving. So every debit entry, there must be a credit entry. And then now we are talking about accounting equation, of which we are saying it is a balance sheet equation that says that a business total assets are equal to sum of its liabilities and its shareholders earnings. So let me try to explain this one with the previous example, so that there are the previous examples that you are talking about the credit and debit entries. So the ledger accounts that we had mentioned earlier, or rather we have created earlier, we want to use the same for this the accounting question, so that you can understand the accounting question. So now I will take you to the Excel workbook. So here in Excel workbook, we have assets account, we have expense account, we have bank account as an asset, we have salaries account as an expense account, we have creditors account, which is a liability, and we have capital account, which is capital. We have stock account, which is an asset. And we also have furniture account, which is an asset. And then now we are saying assets is equal to, so let me say asset is equal to, let me try to write equal to in quoted commas. Asset is equal to liabilities. Assets is equal to capital plus liabilities. So here let's try to okay, let me try to reduce the font size of my account. Let me do 10. So here I want us to see what are assets and what are liabilities. So first we have assets. So assets, we have bank. Assets, here we have bank. Of bank. We have furniture. And we have stock. On this side, capital and liabilities, what we have here, we have creditors. Let me start with capital. Capital, we have capital. Then we have creditors as liabilities. And then also we have, we also must have equity, not equity, but we must have retained. So what is the value of our retained earnings? So here, what we are supposed to write here, that we're supposed to say assets is equal to capital. Instead of writing capital, we're supposed to write here is equal to equity or shareholders equity. Equity plus liabilities. Then we'll get the the value of the asset. So we are saying assets equal to shareholders equity plus liabilities. But bank here, what we have was the value of our bank. The value of what we have as balance carried down is what the value of amount that we have in our bank account. So in our bank account, this is the value that we have. In our creditors account, this is the value that we have. In our capital account, this is what we have. In our furniture account, this is what we have. In our stock account, $6,000. And then of course we also have salaries. The amounts paid for salaries as $2,000. So what are we lacking? We are lacking the retained earnings. So apparently we are having bank is this amount. Furniture we have this amount 7,000, and then we also have stock this amount. And then when we go to capital, we have this amount. And then when we go to creditors, we have 4,500. And then we go to retained earnings, we need to work out the retained earnings. So we are saying total assets should be equal to shareholders equity as liabilities. So liabilities here we have creditors, and then of course we also have retained earnings. So our total assets is equal to sum of these assets. It is equal to sum of all the assets that we have should be our total asset, which is 7,500. This is our total assets. And then now we also need to know the value of our total equity and liabilities. So we need to apply the same principle here. So we also need to add capital plus liabilities plus retained earnings. Then we get the total shareholders equity plus liabilities. But when you check here, we don't have the retained earnings. But what we are having here is salaries expense. But when we are saying when you are trading, you must sell goods to your customers, and then you'll either come with a profit or a loss. Profit comes when the revenue you are getting from your customers is more than the amount you are paying for expenses, and then it is a loss when the revenue you are getting from your customers is less than the expenses you are paid. So far, we've not made any sale to any customer, but we've made payment for salaries to our employees. So we made a payment of 2,000 expense, but we've not made a sale of anything. So apparently, a saving, rather, we are saying our sales is zero. So revenue from our customers is zero. Then the expenses from our expenses, or rather the amount paid for expense is 2,000. So today if I create let me just try to create a revenue account here. So I'll copy this one. I'll create not a revenue account, but I'll try to create profit and loss account. So this is our P&L account. Profit and loss account, and then profit and loss account, we will not call it equity, we will not call it an asset. What's under equity can be it can be a loss or a profit. Let me call it not equity, but I'll call this one under to let's assume this one now we are getting our retained earnings. So I'll say this is our retained. Let me call it retained earnings account. So ladies and gentlemen, I'm just doing this for your understanding, but there's a more proper way of coming up with profit and loss statement. So this is just a simple way for somebody who is coming from a layman point of view who did not understand what accounting is all about, to understand it from this perspective. So this is the simplest way to explain what I mean by equity, or rather assets is equal to shareholders equity plus liability. So this account I'm calling retained earnings account. So here we have we've not made any sale, so there's no revenue. Okay, and then so we are saying sales here, sales revenue, or whatever we call income, is 0. Okay, and then whatever we are having here is so you say all when we are preparing profit and loss account, all the expenses will be on the debit side, and then all the revenues or gains will be on the credit side. So apparently our retained earnings account, we have sales revenue on the credit side. So our expense account, which is salaries account, should be on the debit side. So this one I will call salaries. Then this one I will salaries here is 2,000. Okay. So apparently our balance carried down is a debit balance, and we expect our retained earnings, or rather we expect our revenue to be more than our expenses, and apparently we have only salaries as expense and the revenue is 0. So meaning our retained earnings is negative. It is a debit balance instead of being a credit balance. It should be a credit balance in the sense that revenues and gain should be more than expenses. So when you are trading and you are generating profit and loss, your retained earnings will be positive when your revenue is more than your expenses. But apparently our revenue is 0, and then we have our salaries $2,000. So it means that we've made a loss of 2,000. So our retained earnings is negative. It's not positive. So our balance carried down is a debit balance. Debit balance means the expenses are more than the revenue. So here in our retained earnings, we need to put a negative value of 2,000 shillings. So when you put a negative value of 2,000 shillings, it means that retained earnings is negative. We've made a loss of $2,000. So when we had our loss $2,000 plus creditors 4,500 plus the share capital that we have for $15,000, get a total of 17,500. So here we are showing that assets is equal to shareholders equity plus liability. Shareholders equity here is capital plus retained earnings. So our capital plus retained earnings will be 15,000 minus 2,000, which is 13,000. Then 30,000 if you are to liabilities, which we call creditors, is 4,500. So we are getting 17,000 as 17,500 and assets, and shareholders equity plus liabilities as 17,500. So the accounting equation as balance, or the balance sheet equation as balanced. So we can go back to our explanation of what is meant by accounting equation. So already we've explained what is meant by balancing equation on the example. So we are saying it is a foundation of double entry concept in the accounting. So it means that every debit entry must be credit entry. So by so saying, we mean that assets will be on the debit side, and then shareholders equity and shareholders equity plus liabilities will be on the credit side. So for every debit, or rather for all assets, for all debits value, there must be total value of the same value on the credit side. So all debits must be equal to all credits, and for every debit entry there must be a credit entry. So coming back to our fundamentals of accounting, now we now move to uses of accounting information, of which we are saying we have internal users and we also have external users. So when I talk about internal users, I mean employees. So employees, when you are employed in a company or in a business environment, rather business setup, you are expecting to be paid salaries at the end of a given period. So you'll be interested, you'll be one of the users of the accounting information because you want to know if the business unit or business entity is in a position to pay salaries. So we are also saying the internal users of accounting information are the directors. The directors are those managers that have been bestowed, or rather, they have vested powers to manage the organization. You can have a managing director with the shares or share capital, or managing directors with no shares or with no share capital. So when we talk about directors, we are talking about the top managers of a business unit, top managers of organization. Those are the guys that are giving the business unit the direction of where it's supposed to go. So they must be one of the users of the accounting information. The accounting information here, we are talking about the financial statements. When we talk about the financial statements, we are talking about the profit and loss. We are talking about the balance sheet. We are talking about the cash flow statement. We are talking about the statement of changes in equity. So they must be in a position to have the accounting information so that they can make decisions that is geared to the goodness, or rather the goodwill of the business. And then we also have owners of the business. So owners here we mean the shareholders, those who have put money in the business to run. They're the owners per se, they're the owners of the business. So they must have the accounting information. They must know what the financial statement is saying about the business. So remember, we said the financial statements, the mirrors of what the business is doing, or what the business is operating on, whether it is making losses or profit. It shows they show the value of the business in terms of assets and what capital, or rather the value of the capital, or the value of the shareholders equity. So the owners, they also must have access to accounting information. Then now we also have external users. External users, we say, or rather we say they are creditors, they are investors, they are government, they are trading partners, they are regulatory agencies, they have, or rather they are international standardization agencies, and then of course we also have researchers, journalists. So when we talk about creditors here, we mean by creditors we mean suppliers. Those are those individuals or entities that will supply your business with goods or services. We call them suppliers. And then we also have investors. So investors, we talk of those who are willing to buy shares of your company, or those who are willing to give you money to inject more into a business. Maybe you want to visit your business expansion and you want to go to the bank to take loan and put into your business, or we are calling a banking institution as one of the investors. And they were also calling those who are willing to be part of your business in terms of buying the shares of your business as investors. And then we're also talking about the government or government institution. When we talk about government, they are instructed, rather, they are users of the accounting information in the sense that they will want to know if you're in a position to pay your taxes. So with taxes, we are talking about value-added tax, we are talking about corporate tax, we are talking about pay as you earn for the employees, we are talking about excess duty. So they are users of the accounting information because they want to know if you're in a position to pay these taxes. And then we also have trading partners. So maybe you've started a business. So this business, there's also another trading partner in terms of is a branch, okay? Or you are a branch to another business. So that branch or you as a branch is a trading partner to the branch. And trading partners can also be I call trading partners as also business partners because they are interested in what you are doing as a business. So they become your trading partners. So for example, maybe you started a business and then let me talk of a partnership business, not a sole proprietorship, but a partnership business. So for a partnership business, it is a business being run by more than two people. There can be 2, 3, 4, or 6. The 2, 3, 4, 5, 6 people, we call them trading partners. So they must be interested in the information of the business. So they must be users of the accounting information so that they can make decisions. They can make rational decisions as business is concerned. And then of course we also have regulatory or other regulatory agencies. So these are bodies that regulate how business are being operated. We can talk of Capital Market Authority. That one is one of the regulatory agencies. And then we can also talk of the stock exchange. And the stock exchange can be in a given country or a given region, regulating how shares are being sold and and being bought within, rather, for the listed companies. And then we also have international standardization agencies. So this one deals with standards. So I can talk of, for accounting, we can talk of international accounting standards. And then we can also talk of international financial reporting standards. Those are standards that are governing how we should present our financial statements, or how we should come up with the financial statements. And then I can also talk of international auditing standards, the IAS, International Auditing Standards. So this one will come and check if the books of accounts that you are making or generating comply with the accounting standards that are required, and they portray a true picture, or rather the financial statements that you prepare will portray a true picture of your books of accounts. So they will come and verify by doing independent examination. And then lastly, here we have researchers. So researchers, we just do the research work, the accounting research. So they must be interested in the accounting information. They must use this information to do their research. And then before we move further, we were talking about we started to talk about the accounting concepts, rules, and convention, but we did not talk about the accounting rules and systems. So when we talked about the accounting rules and the system, we had talked about the double entry, the double entry concept, of which we said the double entry rule said that for every debit entry, there must be a corresponding credit entry, or for every credit entry, there must be a debit entry. So this one we also showed in this example, and we had seen these examples for debit entries and credit entries, of which we started with a capital of 10,000. Okay. Then the capital of 10,000 was a credit entry within our capital. And we are saying for every debit entry, there must be a credit entry. So the corresponding debit entry for this capital as opening balance of 10,000 is the opening balance of bank account, which is 10,000. This is the corresponding debit entry of the credit entry of the amount of capital. And then we are saying also that for every debit entry, there must be a credit entry. So we paid our creditors 1,500. So when we paid our creditors, we debited bank by 1,500. So every debit entry must have a corresponding credit entry, and this one is a debit. So we also did the same by crediting our bank account by 1,500. So this close the chapter of every day. Rather, it equates the amount of 1,500 that we debited in our creditors account. And then we also have this other rule: debit the receiver and credit the giver. And we are saying this holds for transaction dealings with humans, or dealing with persons. So what do we mean here? What we mean, for every amount that you as a person receives, there must be a person giving that amount. So when you are receiving that amount, we debit the receiver, and when whoever is giving you that amount gives it out, we credit the giver. So in accounting terms, we will not be talking about the individuals, but we'll be talking about accounts. So here, let me just try to give a simple example. So I will copy this page. Let me paste it here. Then I want to do away with these balances. Okay. Also do away with these balances for the bank. Okay, now the balances are 0, 0. So we are saying debit the receiver and credit the giver. So let's talk about the capital account and the bank account. So now the capital account, we are saying you are, let's assume you are injecting 20,000 into the business. So the 20,000 that you are injecting is capital, and the 20,000 that you are injecting, it will be captured under capital account. So when we talk about debit the receiver and credit the giver, so we are saying capital account is giving bank account 20,000 shillings. So you are injecting money into your business, which is capital, and this money being injected into your business, you are putting it in a bank account. So the bank account receiving and the capital account is giving. So we'll debit the receiver and credit the giver. So the receiver here is bank account, and bank account is receiving money from capital account. So here we'll write capital. So he's receiving 20,000 from capital account. Just make it here. And then capital account is giving bank 20,000 shillings. So here we'll write bank 20,000 shillings. Okay. Then now our balance carried down is equal to sum of all the capital we inject into the business minus all the values that will reduce minus all the values that will reduce our capital with. So our balance carried down 20,000 in our capital account, and the balance carried down under the bank side will be 20,000 shillings. So we debit the receiver and credit the giver. So let's assume again that we are getting a loan from bank, and the bank loan. So let me call this one not a creditor now. I'll call it loan account. So we're getting a bank loan from a banking institution. So the bank will give us 15,000 so that we can inject to our business. So the bank will create a loan account. So loan account is giving our bank account 15,000. Loan account is giving our bank account 15,000. So here we'll say, we'll write here bank 15,000. So loan account is a liability. It can be a creditor, yes, or you can call it long-term liability, which is loan. But for your understanding, just understand that we are getting a loan from a bank, and then we are creating a loan account, and that loan account is giving our bank account 20,000 shilling, 15,000 shillings. So here we'll say that bank has been given 15,000 shillings, and then here bank is getting loan of 15,000 shillings. So we are debiting the receiver. The receiver here is bank account, and we are crediting the giver, and the giver here is loan account. Loan account is giving our bank account, which is an asset, 15,000 shillings. And then now let me move to before then let me just write the balance carried down here as sum of all the loans given, or all the minus sum of all the balances paid. So balance carried down is 15,000 shillings. And then when I move to this other rule, we are saying debit what comes in, and this should be credit. Debit what comes in and credit what goes out. So again, with the practical example here, we are saying debit what comes in. We are talking about this statement here. Debit what comes in and credit what goes out. So let's do this with an example. Debit what comes in and credit what goes out. And let's talk about, let's come here to stock. We want to buy stock. We want to buy stock worth 6,000, not 6,000, but maybe $3,500. So we debit what comes in and credit what goes out. So we are buying the stock in cash. So cash in our bank account, cash worth 3,500 will go out, and in our asset account, or rather stock account, stock worth 3,500 will come in. So we debit what comes in and credit what goes out. So here we'll say bank. We are mentioning bank because we are buying stock with the money coming from bank worth 3,500. And then we are saying you debit what comes in and credit what goes out. So what goes out here is money from our bank account. So we'll credit our bank account. So here we'll say stock. Stock here is worth 3,500. Okay. So now our balance carried down is 31,500 because we've used 3,500. Buy stock worth 3,500. Debit what comes in and credit what goes out. Okay. But again, I can also try the same with creditors. So instead of calling this one loan, let me just call them creditors. So now we are assuming all the creditors are those who are giving us loan, suppliers. Just for your understanding, we are saying the creditors are those who are giving us loan, and they also give us stock in terms of supplies. So I'll write this one. I'll write this as creditors, or to avoid any confusion. let me call this one, let me change the furniture part to be creditors. So the creditors here are the suppliers or the account payable, So we are saying debit what comes in and credit what goes out. So the creditors are giving us stock worth 6,000, let's say 5,000. So already we are debiting what is coming in. So we are getting stock worth 5,000 from creditors. But the other side of the creditors count, we need to credit what goes out. We are giving out goods worth 5,000. So here we write stock 5,000. I think that is a very good example too. It's a very good example to debit what comes in and credit what goes out. But here now the balance carried down here should be sum of all the stocks that we are giving out and a sum of all the amount that we are paying all the amount the suppliers are receiving in terms of payment, so that the balance that goes down. So let's move again to the next rule. So the next rule is saying debit all expenses and losses and credit all incomes and gains. Debit all expenses and losses and credit all incomes and gains. Example, debit salaries account with salaries amount paid and credit bank account. Credit sales account with revenues amount and debit account with all bank account or receivable account with the same amount. So here what we are saying, they are saying debit all expenses and losses and credit all incomes and gains. So when you come here, we debit all expense. So here we are saying the expense we must debit, all incomes we must credit. So let me start with expense. So let's say we are paying salaries worth 6,000 or maybe 2,500. So here when we pay salaries, or let's say you are paying salary through bank, 1,500. So we are debiting all expenses and losses and crediting all incomes and gains. But for now, every debit entry, there must be credit entry. Since salaries we are paying through bank, so we must credit bank account. So here we'll say salaries 2,300. Okay. So we've debited salaries. Now we want to credit all gains and all gains and all incomes and gains. So what we'll do here, we'll create another account. So let's try to create another account this side. So let's try to do away with this one. So return earnings. Now we have let's say this one is sales account. Sales account. So sales, we consider sales as revenue. So now the sales account, we must forget about this one now. We had used it earlier, so just forget about it for a minute. So now we want to credit incomes and gains. So to credit income and gains, we know sales are revenue, they are incomes. So we need to credit revenue. So let's assume we've sold goods worth we sold goods worth 6,000. After selling goods worth 6,000, those are incomes. So when we say sell goods worth 6,000, so we are saying we are selling these goods. So this one now, right balance carried down this side is equal to sum of all the revenue sales minus sum of all the debit entries to our sales account, but this one should be now 0. So if sales revenue worth 6,000, that one is income. So now we must record also the corresponding entry for that sales account, because for every debit entry there must be a credit entry, and for every credit entry there must be a debit entry. For sales, let's assume we sold on credit. So I'll put sales here. I'll put credit sales here, or receivables. So this one I'll call receivables account. So here we sold on credit. We did not sell in cash. Okay. So here amount that we are supposed to receive from our customers by 6,000 shillings. So we are saying sales account, we need to get from our sales account 6,000. Or the sales account is giving the corresponding entry for the credit entry of the sales account is this debit entry of the receivable account. So we are expecting to get 6,000 from our customers. So this one is receivable, although the money has been earned as sales revenue. So here our balance carried down is a debit balance. So it will be the sum of all the amount we expect from our customers minus sum of all the amount that they will have paid us at a given period. So that's how to credit all the incomes and gains and debit all the expenses. So in short, we are saying that if we now close this chapter, we are saying that assets, when you debit asset, you will increase on the asset, but when you credit asset, you will decrease the asset. And then when you come to liabilities and capital, when you debit the liability or capital, you will decrease the liability or capital. And when you debit, rather when you credit the liability and capital, you will increase capital or liability. And when we come to expenses stroke losses, when you debit the expense, you increase the expense. When you credit the expense or loss, you reduce or decrease the expense or loss. So when it comes to revenue and gains, when you debit revenue, you decrease the revenue. And then when you credit revenue, you increase the revenue stroke gains. So ladies and gentlemen, I think so far we've done almost everything in chapter 1. Not almost everything, we've done everything in chapter 1. The principles of accounting. So we've done almost everything. So moving here, we'll go to chapter 2, but chapter 2 will start on the next video. So just a recap on what we've done in terms of fundamental principles of accounting. If I just take you up where we started. So we started with the definition of terms, of which we talked about what accounting is all about. Then we talked about the meaningful ways of accounting, the accounting process, the branches of accounting, and then we moved to elements, the basic elements of accounting. We've also done financial statement, but financial statement we just mentioned, we've not tackled it fully. Just mentioned financial statements. So this one will cover in chapter 2, going forward to chapter 3. And then we've also talked about what is interested in financial statements. And then we've also talked about concepts, rules, and conventions. And then we've also talked about debit. We've talked about debit, credit, and the accounting equation, of which we've explained what is meant by debit, what is meant by credit, debit note, credit note. And then we've also talked about the accounting equation. And lastly, we also talked about uses of accounting information. So ladies and gentlemen, if you have a question of all this that we talked about, please just put your comment down there. And then moving forward, we'll go to chapter 2. And chapter 2 will capture quite a lot, and this will be more practical than the things that we've done. So in chapter 2, we'll talk about accounting for revenues and expenses. Then after finishing this chapter, we'll go to chapter 3, and chapter 3 will be talking about assets and liabilities. And from there again, we'll talk about equity as well, rather capital and equity So ladies and gentlemen, thanks a lot for watching, and please subscribe if you are coming for the first time, and share your comments, share the video, and let's meet again on the next video.